Welcome to the deep dive. This week, we are wading into a market environment that it really feels like a genuine high-stakes tug of war.
Yeah, that's a good way to put it.
On one side, you've got this almost paralyzing top-down policy uncertainty, right, coming straight from the Federal Reserve. And then on the other side, you've got this intense bottom-up volatility, stuff created by company-specific news that's just generating these massive swings in individual stocks.
That tension is absolutely the defining feature of the market right now. I mean, if you're trying to gain essential market intelligence quickly, but, thoroughly for the week of October 6th, our mission here is really to cut through that noise.
Exactly.
We want to analyze both the macro and the micro forces and sort of explain why certain events matter more than others this week.
Okay.
What we're seeing is a market poised for, well, we're calling it heightened vigilance.
Heightened vigilance. I like that.
Yeah, the broad indices, they're kind of stuck, right, in a holding pattern that's, frankly, been pretty frustrating for momentum traders. But the volatility bubbling underneath, at the individual stock level, that's generating significant opportunity and significant risk.
Okay, so what are the dominant forces driving this? We've identified sort of a triple threat of themes that are going to dictate the action, the volatility across our focus areas today. Stock market futures, those pre-market movers, and then the economic and earnings calendars.
Right. First, the overarching theme is purely Fed-centric focus. It just is.
All about the Fed.
Monetary policy guidance is the primary, let's call it the gravitational driver of global market direction right now. Everything else feels secondary until we get some clarity there.
Okay.
So we're looking squarely at the FOMC minutes midweek, and critically, that speech from Chair Powell on Thursday, that's the top-down pressure-defining investor risk appetite.
Got it. And second, and this is where, the action is happening right now, early in the week, this is absolutely a stock picker's market.
Oh, absolutely.
You just have to look at the pre-market movers, which we're definitely going to dive into. I mean, double-digit swings in biotech, energy, tech names.
Huge moves.
And these moves are driven by fundamental news, right? Clinical trial results, M&A, capital raises, stuff that seems to be operating completely independently of what the Fed is maybe hinting at about inflation targets down the road.
Exactly. It's like two different worlds sometimes. And then third, we've got crucial corporate bellwethers reporting earnings on Thursday.
Right. PepsiCo and Delta.
Specifically, PepsiCo, PEP, and Delta Airlines, DAL. And these reports, they're not just about those two companies. They serve as really essential real-time indicators. They tell us what consumers and corporations are actually doing with their disposable income. It's a vital bottom-up check on that whole macroeconomic narrative the Fed is trying to shape.
Okay, so the immediate outlook then. It sounds like cautious consolidation, maybe quiet to start.
Yeah, I think that's right. We expect trading to be quiet initially, maybe even a bit boring. But the probability of some pretty severe event-driven volatility, that increases dramatically as we move toward midweek. It really peaks on Thursday.
Okay, let's unpack this, starting with the biggest picture first. Global futures analysis, the Fed's shadow, and this idea of international decoupling.
Okay. So if you look at U.S. index futures right now, I mean, it's almost a textbook definition of a market in waiting. It's almost timid.
Yeah, really muted.
Early indications were barely mixed, reflecting just maximum investor reticence. We saw the Dow Jones futures clinging to a tiny gain, maybe up, plus 0.049% to plus 0.07%. Barely anything.
Practically flat.
The S&P 500 futures were just hugging that flat line, hovering near 0% to maybe plus 0.10%. NASDAQ 100, which usually shows a bit more optimism, was slightly stronger, maybe up plus 0.13%.
But what's fascinating, and Marty, just typical lately, is that even that tiny glimmer of green just sort of faded as the session went on. Yeah. We saw that that inevitable tick down that we've kind of gotten used to when the market doesn't have a clear signal, no real conviction. Dow futures flipped slightly negative, nettable 0.01%. S&P 500 futures edged down to nettable 0.08%, and the NASDAQ 100 eased to nettable 0.12%.
Right.
I mean, we're talking basis points here, not big percentages, but like you said, it tells a story.
It tells us that investors are just unwilling to commit capital in any major directional way right now. And this isn't market apathy, I don't think. This is pure Fed-induced paralysis.
Fed-induced paralysis, yeah.
Investors, proprietary trading desks, they've largely priced in the current economic conditions, the current policy rates. They are now entirely dependent on getting some kind of forward guidance from the Fed before taking that next major directional step, whether it's bullish or bearish.
They're just stuck.
Yeah. The moment a piece of contradictory data or maybe some hawkish language pops up, you just get this rush for the exit, this current stillness, this stasis. It's purely a function of intense focus on that single variable future rate paths.
So, if the market is paralyzed, what specifically is causing it? Are traders more worried about, say, the terminal rate? Or is it the speed of potential cuts in 2025? What's the key anxiety?
It's primarily the uncertainty around the timing and the pace of those potential 2025 cuts. I mean, the Fed's done a decent job anchoring expectations around current inflation, but the market's now really fixated on this possibility that the neutral rate, R star, might actually be higher than everyone previously assumed.
Right.
So if those FOMC minutes suggest there's an internal debate about maybe raising the long-term neutral rate assumption, well, that drastically changes the valuation models for growth stocks. It just pulls the rug out from under the rate cuts the market's been banking on for next year.
Okay, so that fear of having to reprice the entire yield curve, that's what's causing this don't move situation. Nobody wants to risk being caught out before they get clarity.
That's exactly it. Nobody wants to risk being pre-positioned incorrectly.
And this is where the global picture gets really interesting, because while the U.S. market is frozen, stuck on domestic policy worries, outside the U.S., we're seeing a completely different story, a significant international decoupling.
Absolutely. It's a stark contrast. Look at Asian markets, for instance. They showed considerable momentum, completely shrugging off the U.S. caution. Japan's Nikkei 225 futures were up robustly, soaring plus 1.80%, even pushing over plus 2.06% at one point.
Wow, that's a huge move for an index.
It's a massive conviction-driven move, and it really demonstrates that powerful micro-level catalysts can, well, at least temporarily, completely override that cautious U.S. macro narrative.
So what was the specific catalyst there? We know it was a corporate deal, but why did one deal move the entire Nikkei so dramatically?
Well, it wasn't just any deal. It was a strategically really significant move by a major corporate bellwether. SoftBank Group announced they're acquiring ABB's industrial robotics unit for about $5.4 billion. That news alone sent SoftBank shares themselves soaring over 11%. But the wider implication is key here. SoftBank, post that big ARM IPO, is signaling this deep, sustained confidence in high-tech industrial growth, particularly in automation and robotics.
Right.
This acquisition wasn't seen as some speculative gamble. It was viewed as a confident step into a foundational sector for future manufacturing.
So the market read it as more than just SoftBank, like a structural vote of confidence in Japan's tech ecosystem, lifting the whole index.
Precisely. It signals that these cash-rich, forward-looking Japanese firms are making bold, value-accretive bets on their future industrial capacity. That gives the whole market momentum, kind of independent of what the U.S. yield curve is doing.
Interesting.
And you also saw, China's Shanghai Composite showing strength, too, up about plus 1.32%, although that was probably more on different factors, maybe anticipation of more government stimulus there.
Okay. Now, Europe offered, like, a third perspective, right? More fragmented.
Yeah, definitely fragmented. Germany's DAX showed some modest gains, around plus 0.35%, which maybe suggests some underlying resilience in the Eurozone's core.
Okay.
But then you had the UK's FTSE 100 down minus 0.27%, and Italy's IT 40 down minus 0.38%. So a real mix. It suggests that localized economic concerns may be related to inflation persistence, or specific energy import issues are weighing pretty heavily on those specific national economies.
So the synthesis here, the takeaway for global investors, is that global market performance is definitely not monolithic right now.
Not at all. We're seeing significant regional decoupling from the U.S. macro story, and it's being driven by powerful localized catalysts. So for you, the listener, this really means international allocation requires some pretty forensic stock picking based on fundamental regional news. You can't just bet on broad global correlations tied to the Fed anymore.
Right. You need to dig deeper regionally.
Yeah.
Okay, let's round out this macro view. Let's look at the risk gauges, commodities, and volatility. And this picture seems a bit complicated, right? Because we're seeing safe haven gold and risk-sensitive oil both moving higher.
Yeah, it's a bit of a paradox. Gold futures are trading higher, up about plus 0.39%, getting close to $4,060 an ounce. Crude oil, WTI, is also up modestly, around plus 0.50%, near $62.86 a barrel.
So why are they both up? Usually they move inversely, don't they?
Often, yes. The simultaneous rise here is pretty fascinating. Gold is the classic hedge, right? While crude oil is often sensitive to global industrial demand and risk appetite.
Okay.
In the case of gold, we're likely seeing what you could call a dual-purpose trade. It probably reflects two different timelines for investors.
What are those two timelines?
Well, on one hand, it's that immediate hedge against Fed uncertainty. If Powell surprises everyone with hawkish talk on Thursday, gold offers that non-correlated safe place to hide.
Right.
But maybe more critically, it's also a forward-looking bet on those potential 2025 rate cuts. If the Fed does ease next year, the opportunity cost of holding non-yielding gold drops significantly, making it more attractive. You can see managed money flows positioning for that outcome.
Okay, that makes sense. Hedge now, bet on cuts later.
Exactly. And, some technical analysts might also interpret this positive correlation between gold and crude as maybe a subtle signal of stagflationary fears.
Stagflation, the worst of both worlds.
Right, where inflation stays high, boosting oil, while growth slows down, leading investors to hedge with gold. It's a possibility to keep an eye on.
And what about the VIX, the volatility index? If everyone's paralyzed, shouldn't the VIX be, flat or even dropping?
Well, not quite. S&P 500 VIX futures are actually up slightly, about plus 0.49%.
Okay, so a little bit of nervousness.
Yeah, it confirms this low-level internal hum of anxiety. This slight rise isn't really a reaction to a crisis that's already happened, but it feels more like preparation for information. It's consistent with a market that is bracing for information, waiting for the shoes to drop on Wednesday and Thursday rather than reacting to stress that's already here.
So it reinforces that heightened vigilance idea we started with.
Exactly. Everyone's just waiting, a little on edge.
Okay, let's leave the paralyzing macro forces behind for a minute. Let's dive into the chaos of the micro market. Segment 2. Pre-market movers, these catalysts that seem to ignore the macro, this is where that stock picker's market idea really comes alive, right?
Yeah.
Generating some serious alpha or risk, regardless of what those flat futures indices are doing.
Yeah, this is where you see the sheer magnitude of company fundamentals just asserting themselves. I mean, the gains and losses we're seeing here are substantial, and they're driven purely by specific news clinical trial results, strategic corporate actions, or just the immediate dilution math of a capital raise.
Okay, starting with the leading gainers. It looks like the top is dominated by biotech breakthroughs and some strategic M&A. Nanobiotics SA, ticker NBTX, is the top gainer, soaring an incredible plus 30.19% to $27.30.
30%.
30% on phase 1 data. That's really remarkable. Usually you see those initial trial results pull back pretty quickly if the market thinks the first reaction was too much. What tells us this move might actually have legs?
Well, the context of the data itself suggests the move has some genuine substance behind it. The immediate catalyst was promising first data from a phase 1 study for their lead candidate, J&J 1900, in esophageal cancer.
Okay.
They reported a 69% objective response rate, or ORR, and that included 6 complete responses. Now, just to put that 69% ORR in context for you, the ORR is the percentage of patients whose cancer shrinks or disappears after treatment. For a phase 1 study, which is primarily about safety, hitting a 69% ORR is extremely potent.
And getting 6 complete responses, meaning the cancer completely disappeared, at least detectably, that must be the strongest driver of that conviction.
Absolutely. That demonstrates real clinical promise, potential efficacy very early in the development cycle. It reinforces this strong narrative that their therapeutic platform could be highly effective in these really challenging cancers. And it's also important, I think, that this follows a pretty steady stream of positive news they've had in related cancers like head and neck. It suggests their approach might be widely applicable.
Okay, so real science driving that one. Then you've got Diginex Limited, DGNX, up plus 28.06%. This looks like a great example of strategic execution driving value, maybe in a less traditional tech space.
Yeah, this is a story about strategic focus on a high-growth area. Diginex just completed the acquisition of MatterDK APS. Now, MatterDK is an innovative ESG data company.
ESG data. Very hot space.
Exactly. The market sees this as a major step in strengthening Diginex's position in the rapidly expanding sustainability regulatory technology space, or RegTech for short.
RegTech, got it.
In a world with just increasing environmental and social reporting mandates coming down the pike, being a leader in data aggregation and compliance tools, well, that's a high-value strategy, and it seems to warrant this kind of aggressive growth re-rating we saw pre-market.
Makes sense. And finally, among the big gainers, Zenus Biopharma Inc., ZBIO, jumped plus 24.22% pre-market on what they correctly labeled a transformational announcement.
Yeah, transformational seems about right here. The centerpiece is a major licensing agreement for 3 autoimmune drug candidates. One of them is orelibrutinib.
Orelibrutinib, okay.
Yeah, it's a BTK inhibitor currently in phase 3 development for multiple sclerosis. Now, a BTK inhibitor, it works by blocking an enzyme called Bruton's tyrosine kinase, which is critical for certain immune cells that drive autoimmune disorders. So by licensing these drugs, Zenas significantly accelerates their pipeline. But the financial component alongside this deal is really the differentiator.
Right. You're talking about the concurrent $120 million institutional private placement.
No.
Why would the market cheer a capital raise? Doesn't that almost always mean dilution and push the stock down?
This is the crucial point, and it's really important for you listening to grasp this difference. That $120 million raise, which was supported by big institutional investors, effectively de-risks the company's financial position, and it validates the strategic move they just made.
Oh.
That capital is immediately earmarked to fund these newly licensed high-potential programs. So the market perceived this financing as growth capital tied directly to value-adding assets. It wasn't seen as survival capital, just to keep the lights on.
Got it. So the added long-term value from the deal and the funding was seen as outweighing the immediate dilution hit.
Precisely. And that sets up a perfect comparison when we look at the losers list.
Okay, let's pivot then to the significant losers. The stock's getting weighed down by financial actions and disappointing outlooks. Top of the list is Nano Nuclear Energy Inc., NNE, plummeting negative 16.93%.
Right. And here you have the exact opposite reaction to Zenas when it comes to raising capital. Nano Nuclear announced a large, apparently oversubscribed, $400 million private placement.
$400 million, that's a big raise.
Huge. And while this operational cash injection is vital for them, I mean, it boosts their cash position to $600 million, which they need to fund their micronuclear reactor program. It involves issuing 8.49 million new shares at $47 per share.
Oof, that's the dilution hammer.
That creates significant and immediate dilution for existing shareholders. Plain and simple.
So even though the cash gives them a much longer operational runway for their technology, the immediate dilution math just completely dominated the market reaction.
Absolutely. The stock had actually enjoyed a nice 5-day rally leading up to this, but that momentum became completely irrelevant when faced with the sheer arithmetic of the dilution. The perception here is that the immediate cost to existing shareholders is just too high.
Right.
It signals that the company needed this money urgently and was willing to pay a heavy price in shareholder equity to get it. And that's the difference between capital that fuels a transformative deal like Zenas and capital that just funds long, slow, maybe uncertain development like here.
Okay, that distinction is crystal clear. Then you have Penguin Solutions Inc., PEG, down negative 16.02%. This is interesting because it's a post-earnings hangover, but they actually reported an adjusted EPS beat. $0.43 versus the $1.37 consensus. That feels really counterintuitive.
It does, but it highlights a critical lesson, especially in today's market. Equity valuation is a forward-looking exercise. It's not a retrospective report card on the last quarter.
Right.
That slight EPS beat was basically rendered moot by 2 major negative factors. First, they did miss on revenue consensus, came in at $337.9 million versus the $342.1 million expected.
Okay, a small miss, but still a miss.
Exactly. But the real hammer blow came from their weak fiscal year 2026 guidance. The forecast they gave for adjusted EPS came in significantly below what analysts were estimating.
And the guidance. That's the killer.
Always. It signaled a potentially weaker growth trajectory than the market had banked on for the next couple of years. That forced a swift re-rating of their long-term potential, leading to that massive sell-off. The market penalizes a weak forward outlook far more severely than it rewards a minor historical beat.
Lesson learned. Okay, finally on the losers list, we have Taskas Inc., Task, lower by negative 12.46%. Here, the core issue seems to be uncertainty around a corporate transaction. Is that right?
That's right, and it was compounded by some analyst action. The stock is declining ahead of a pretty critical stockholder vote on a proposed take-private transaction. It's being led by Blackstone and the company's co-founders.
Okay.
The fact that this shareholder meeting has been repeatedly adjourned creates significant doubt about whether the deal will actually close. It suggests maybe there are internal disagreements or perhaps regulatory hurdles they're hitting, just uncertainty.
But wasn't the deal already priced at a premium? Why would a Morgan Stanley downgrade suddenly be the catalyst for a double-digit drop now?
Well, Morgan Stanley essentially just removed the risk-reward arbitrage opportunity that maybe some professional traders were playing. They downgraded the stock to equal weight, but crucially, they set a price target matching the $16.50 offer price from the take-private deal.
Ah, okay, so no upside left?
Exactly. That move basically tells the market, look, there's virtually zero upside beyond the deal price. If the deal closes, you make marginal money, maybe pennies. But if the deal fails, well, the stock probably falls back to its intrinsic value, potentially far below the $14 to $15 range it was trading in. That leaves investors severely exposed to the downside.
Right. So the downgrade removed the reason to hold the stock hoping for the deal and introduced significant downside risk if it falls apart, prompting an exodus.
Precisely. It just changed the risk calculus completely.
Okay, the expert synthesis you drew between Zenith and nanonuclear really feels like the key takeaway from this whole mover segment. If I'm boiling it down for the listener, it sounds like the context of the capital raise. Is it survival money or strategic growth money? That's the only thing that matters right now when you're assessing dilution risk.
That's the perfect summary. The narrative surrounding how that capital is going to be deployed is paramount. If the money funds the future, maybe brings in high-quality institutional partners like with Zenith, then dilution is often tolerated, even cheered sometimes. But if the money merely keeps the operational engine running while significantly diluting existing equity, like with nanonuclear, the market punishes it severely.
Got it. Okay, let's shift gears now to segment 3. The economic and corporate horizon decoding the high-impact schedule. We noted earlier this is a very backloaded week. The first couple of days likely pretty quiet on the data front.
Yeah, exactly. We're expecting fairly quiet trading volumes probably until midweek. Everything really starts happening Wednesday afternoon. That makes Wednesday and Thursday the real make-or-break days for volatility this week.
Okay, so Wednesday, October 8th. The main event looks like the FOMC meeting minutes at 2:00 p.m. Eastern Time. We've already established investors are, let's say, obsessed with the future path of interest rates.
Obsessed is probably the right word. And the minutes are our most detailed chance to get insight into the internal debate among the policymakers, the stuff that wasn't captured in that initial post-meeting statement or press conference.
Right, going beyond the headlines.
We need to go beyond the summary statement and look for specific language nuances. The market will be absolutely laser-focused on any discussion about the threshold for declaring victory on inflation, and crucially, any hints about the timing and pace of those potential 2025 rate cuts.
So what specific phrases or, topics should you, the listener, be watching for in that release that might trigger a strong market reaction either way?
Okay, look for mentions of the neutral rate or R-star. If we see evidence in the minutes that more members are maybe aligning with the idea of a structurally higher neutral rate long-term, that's immediately hawkish.
Why hawkish?
Because it implies rates will probably need to stay higher for longer than previously thought to be restrictive. Conversely, any extensive discussion in the minutes about specific slowing trends, maybe in economic growth or particularly in the labor market, that will be seen as dovish. Also, watch for dissent. If there was strong dissent noted in the minutes, maybe favoring a pause or cut sooner, that could trigger a significant relief rally in equities.
Okay, neutral rate, signs of slowing, and dissent. Got it. Then we move into the really critical day, Thursday, October 9th. We get a dual punch of high-impact news right at 8:30 a.m. Eastern.
That's right. First up, we get the initial jobless claims report. This is always a high-impact number because it's a near real-time barometer of labor health. It's often seen as a bit of a precursor to the big monthly non-farm payrolls report.
And the consensus.
Consensus is looking for about 227,000 new claims. That's up slightly from the previous week's 218,000. Now, a number significantly above, say, 235,000, that could instantly fuel recession fears. It would increase pressure on the Fed to maybe ease policy sooner, and you could see a major reaction in futures trading almost immediately.
But running concurrently at the exact same time, 8:30 a.m. Eastern, and potentially completely overshadowing those claims numbers, is the speech by Fed Chair Jerome Powell.
Yep. The main event. Global markets will parse every single word, every nuance of his tone on everything inflation, employment, the forward policy path.
His tone really has the power to just validate or completely upend market expectations in minutes, doesn't it?
Absolutely. He'll be walking that very fine tightrope, trying to communicate data dependency without committing to a specific policy move ahead of time. If he emphasizes the risks of easing too soon, that hawkish message will immediately pressure long-duration assets like growth stocks. But if he hedges that, maybe with clear acknowledgement of slowing job growth data we've seen, the market could stabilize or even rally. It's all about the balance.
And it's not just Powell speaking this week, right? We have multiple Fed officials you mentioned, Bowman, Barr, Goolsbee, others scheduled to speak throughout the week. You flagged this earlier as a potential risk of central bank overload.
Exactly. When you have so many Fed officials speaking sequentially, especially in a data-dependent environment, there's a serious risk that algorithms and human traders overinterpret minor differences in their messaging. It can create this chaotic echo chamber effect. Well, for instance, if one governor uses slightly stronger language about, say, the inflation fight than Powell did earlier in the day, traders might instantly reprice rate expectations based on that perceived divergence. Even if it doesn't reflect a true split in policy thinking at the FOMC, it just leads to unnecessary and potentially quite dangerous short-term volatility.
Right. Noise trading, essentially.
Okay.
Beyond the speeches, Thursday afternoon features something you called a crucial credibility test for the Fed. The 30-year bond auction at 1:00 p.m. Eastern. This isn't just about the Treasury selling debt, is it? It's more like a statement on long-term confidence.
It absolutely is. Think of it as a real money referendum on the Fed's long-term inflation control credibility. When the government sells long-duration debt like the 30-year bond, the bond market is essentially placing bets on long-term inflation risk.
Okay.
So if we see weak demand for that 30-year paper, which would be signaled by a higher than expected yield needed to sell it all, it means bond investors are demanding a higher risk premium.
And why does weak demand for long bonds mean they demand a higher risk premium? What's the link?
Because it signals the market doesn't fully believe the Fed will successfully bring inflation all the way back down to its 2% target over the next 30 years. Or perhaps they believe Fed policy itself is just too unpredictable right now. So if the market demands, say, a 5.1% yield when expectations were maybe 4.9%, that extra 20 basis points, that's the cost of skepticism.
Got it.
And that higher long-term rate puts immediate upward pressure on all sorts of borrowing costs across the economy, mortgages, corporate debt. It basically contradicts any dovish rhetoric Powell might have delivered earlier and directly challenges the Fed's credibility to maintain stable prices over the really long haul.
Wow. Okay, so a wonky bond auction can actually undermine the Fed chair's message. Fascinating. Now, let's overlay the corporate earnings onto this packed macroeconomic schedule, particularly focusing on those crucial reports scheduled for Thursday morning, October 9th. This is what you called our essential K-shaped economy diagnostic.
Exactly. We have two major bellwethers reporting before the market opens that morning, PepsiCo and Delta Airlines. And together, they provide this incredibly useful snapshot across different income demographics, which is really helpful for refining sector strategies right now.
Okay, let's start with PepsiCo, PP. Expected EPS is $2.26 on revenue of about $23.9 billion. This is our definitive mass market barometer, right?
Yeah.
Gauging the health of the average consumer.
That's right. And the key metric for PepsiCo, maybe surprisingly, isn't profit margins this time. It's organic volume growth. Analysts are extremely cautious here, anticipating a pretty challenging quarter because of all the sustained price hikes PepsiCo and others have pushed through.
Right.
So if we see a significant slowdown or maybe even a negative number for organic volume growth that suggests consumer elasticity, the consumer's ability and willingness to absorb those price increases is finally breaking under this persistent inflation.
And if the average consumer is cutting back on staples like snacks and drinks, what does that signal about the broader economy?
Well, it signals potentially profound trouble for the entire consumer staples sector, and it definitely raises recessionary alarms. It would mean that lower and middle income households are really running out of budget slack, forcing them to cut back even on things that felt non-discretionary, or maybe impulse staples like, snacks and beverages.
So we should watch how their Frito-Lay snack volume holds up compared to their beverage segment, maybe.
Yeah, that's a good comparison to make. Snacks often show earlier signs of consumer stress than, say, core beverages, so that split could be telling.
Okay. Now, contrast that immediately with Delta Airlines, DAL. Expected EPS is $1.53 on revenue of $15.9 billion. This is our premium travel gauge.
Right. And the outlook here, generally speaking, is much more optimistic. It reflects the resilience we've seen at the higher end of the income spectrum. Delta's core profitability is really driven by that high-margin corporate travel segment.
Yeah.
And premium leisure flyers specifically, the people paying up for Delta One and premium select cabins.
So what are the key focus areas for investors looking at the Delta report? What metrics matter most?
Investors will focus intensely on revenue per available seat mile, or RSM. That's the key measure of their pricing power. Strong ORSA means they're still able to charge high prices because demand from those segments remains resilient.
Okay.
And maybe even more importantly, we need their forward guidance, particularly for the critical holiday travel season coming up. Robust bookings reported there, strong commentary on corporate travel trends. That would suggest continued economic resilience among wealthier households and among businesses. That's a powerful, hard data point.
Okay, so let's put those two reports together hypothetically. If we get, say, a weak PepsiCo report showing volumes falling and a strong Delta report showing robust premium demand and bookings, what diagnostic does that give us about the state of the U.S. consumer?
Well, that scenario provides pretty compelling evidence of a severe economic bifurcation. It's the textbook definition of a K-shaped economy.
Okay, explain the K-shape again.
The top arm of the K is doing well. Higher income households, the ones flying in Delta's premium cabins, the ones whose companies are still paying for corporate travel, they're continuing to spend freely. Meanwhile, the bottom arm of the K is pointing down. The core PepsiCo base, the lower and middle income consumers, they're pulling back significantly on everyday items, likely due to that inflationary pressure hitting their budgets harder.
Right. So that outcome would strongly inform sector rotation strategies, right? Maybe favoring premium discretionary stocks over mass market staples.
Absolutely. It would be a very clear signal for that kind of rotation.
Okay. Finally, the week wraps up on Friday, October 10th with more of a soft data check, the preliminary University of Michigan Consumer Sentiment Report.
Right. This just provides a survey-based view on the consumer mindset, their financial outlook. Consensus suggests a slight dip from the previous reading of 55.1 down to maybe 54.2.
So how do we use that?
Well, we need to monitor the sentiment reading against the hard spending data we hopefully get from Delta and PepsiCo the day before. For example, if sentiment comes in weak on Friday, but Delta's actual bookings data on Thursday was strong, that might suggest consumer anxiety is higher than actual spending constraints, at least for the wealthier consumer. Or maybe it suggests the sentiment survey is just accurately capturing the distress we might have seen in the PepsiCo data from the lower end. It adds context.
Okay, that makes sense. Which brings us to our synthesis and forward outlook for the week. We've definitely established this core tension between the macro policy waiting game and these sharp micro catalysts.
Yeah, the core conflict driving everything this week, and absolutely the market's dependence on the Fed's macro pronouncements clashing with these high-impact granular details coming out of corporate America. And that creates this really volatile feedback loop.
And the interplay between those forces is really going to define market direction day to day. Like you said, a surprisingly hawkish Powell tone on Thursday could easily overshadow even a strong bullish report from Delta, right?
Oh, absolutely. Rising rate expectations just pressure valuations across the board, even for fundamentally healthy companies. Ultimately, the cost of capital matters most in that scenario.
But conversely, surprisingly weak earnings from a consumer staple bellwether like PepsiCo, showing real volume declines that could significantly accelerate existing recessionary fears.
It could. And that might actually push the Fed, maybe rhetorically at least, into a more dovish corner later in the week, just to try and stabilize markets and manage those expectations. It creates that complex internal policy debate we expect to maybe see hints of in the FOMC minutes.
And we really have to monitor that soft versus hard data contrast on Friday, too. Weak consumer sentiment, the soft survey data contrasted against potentially strong corporate spending data from earnings, the hard data. That would be a critical insight, wouldn't it? Into whether consumer anxiety is truly translating to restrained behavior across the board, or if that anxiety is mostly confined to the lower income brackets, while overall consumption stays surprisingly robust.
Yeah, that contrast will be very telling. So volatility is really the watchword for the back half of the week. Expect a quiet start, but volumes and volatility are highly likely to spike significantly, starting Wednesday afternoon with the FOMC minutes, carrying right through Thursday's big events, Powell claims, the auction, and continuing into Friday's sentiment check.
And the primary risks. What should listeners really brace for?
The primary risks remain, I think, number one, a hawkish surprise from the Federal Reserve, maybe Powell sounding tougher than expected, or number two, major guidance or revenue miss from one of those consumer bellwethers, PEP or DAL, that confirms widespread consumer capitulation is actually happening. Either of those could really move markets sharply.
Okay, so thinking back to the beginning.
Yeah.
We saw that significant regional decoupling this week. Asia, specifically the Nikkei, was powered higher by a fundamental corporate deal, that SoftBank acquisition, while the U.S. market just sat paralyzed waiting for the Fed. This raises, I think, a crucial final question for you, the listener, to maybe mull over as this week heats up. Can these powerful localized catalysts like a big M&A deal or strong regional earnings permanently override a restrictive U.S. macro environment? Or is the global market still just too fundamentally intertwined with U.S. dollar dominance and Fed policy to allow for true, long-term regional independence?
That is the big question, isn't it?
Yeah. The answer to that question, whatever it turns out to be, is probably going to define global investment strategy for the next decade. Something to think about.